Hey everyone, and welcome back to the channel. If you're new here, I'm really glad you found your way in, because today's video might just be one of the most important financial lessons you'll ever watch. Let me ask you something. Have you ever looked at your bank account and thought, okay, I'm saving, but am I actually growing my money? Or maybe you've got a little cash sitting there and it's just existing, not doing much, and thanks to inflation, it might even be losing value over time. You've probably heard people talk about investing in the stock market, right? Stocks are the key to wealth. Put your money to work. Buy the dip. But if you're like most people, especially when you're just starting out, all that talk can feel overwhelming. Like you need a finance degree just to understand what they're saying. Or worse, you're afraid of doing it wrong and losing your hard-earned money. Believe me, I've been there. And here's the truth. It doesn't have to be that way. Stock investing can be simple. It can be safe. And more than anything, it can be life-changing. Today, we're gonna break it all down, from the absolute basics of what stock investing actually is, to why it's one of the most powerful tools you have to build real wealth over time. Not overnight, not with risky bets or wild stock tips, but with a steady, smart strategy that anyone, yes, you, can start using today. We'll also be bringing in insights from people who've actually done it, names you might know, like Dave Ramsey and Tilbury. These are voices that have helped millions of everyday people take control of their financial futures. And together, we'll use their wisdom to build you a clear, beginner-friendly roadmap for getting started, even if you've never invested a single dollar before. Even if you feel like you don't know enough, this video is for you. And hey, if you're already investing a little bit, or maybe you've dabbled and felt stuck, stick around. We're going to simplify a lot of common confusion and show you how to turn basic habits into long-term success. So grab a coffee, settle in, and get ready, because by the end of this video, you won't just understand stock investing, you'll be ready to take action. All right, let's dive in. Part 1, why should you even invest? Alright, let's start with the big question. Why should you even invest? I get it. For a lot of people, the idea of investing sounds complicated, or risky, or something only rich people or finance nerds do. But here's what no one tells you. If you're not investing, you're actually falling behind. Here's why. Every year, the cost of living goes up. That's inflation. Groceries, rent, gas. It all slowly gets more expensive. Even if it's just 2 to 3% a year, over time, that adds up in a big way. Meanwhile, most savings accounts give you, maybe 0.5% interest if you're lucky. So your money in the bank is actually losing buying power every year. Now think about that. You work hard for your money, but if it's just sitting in a savings account, it's shrinking in value. Investing is how you fight back. One of the best known personal finance experts out there, Dave Ramsey, puts it like this: your income is your most powerful wealth building tool. But there's a catch. If all your income is going toward debt, you can't use it to build anything. Take a look at this stat. The average car payment in the US is now over $500 a month. Let's just sit with that for a second. $500 a month. That's $6,000 a year. And if you're financing cars over and over, that's decades of payments. Now imagine if you invested that $500 a month instead. Let's run the numbers. If you started at age 30, investing $500 every single month into a good growth stock mutual fund that averages 10% per year and kept going until you're 70, that's 40 years of consistent investing. You wouldn't just have a little retirement cushion. You'd have over $5 million. That's not fantasy. That's basic compound interest math. It's the magic of letting your money grow, not just once, but again and again as your gains start to generate their own gains. But here's the real secret. It's not about timing the market. It's not about finding the perfect stock. Most millionaires didn't get there by hitting some lottery ticket investment. They did it by being consistent. In fact, studies show that 74% of retirement success comes down to just one thing: regular saving, month after month, year after year, rain or shine. That's what we call your savings rate. How much of your income you consistently set aside to grow. And it's one of the most important decisions you can make for your future. So why invest? Because it's how you buy your freedom. It's how you stop trading time for money. It's how you give your future self options. Options to retire early, travel more, take care of your family, or pursue the life you actually want, not just the one you can afford in the moment. And the best part, it doesn't take a finance degree. You don't need to be rich to start. You just need a plan and the discipline to stick with it. Part 2. Before you invest, prepare your foundation. Right, so you're pumped to start investing. You're thinking about stocks, maybe a little crypto, or diving into index funds. But hold on, before you put a single dollar into the market, there's one absolutely critical thing you need first: your foundation, and that foundation starts with an emergency fund. Now I know, this might not sound exciting. You're here for investing tips, not savings advice, right? But hear me out. This step is the difference between building wealth safely or setting yourself up for a financial disaster. Mark Tilbury, a successful investor and popular finance educator, says you should have 3 to 5 months worth of living expenses set aside before you invest. Not because he's against investing, but because he's seen what happens when people skip this step. Here's the reality. Life happens. Your car breaks down, you get laid off, your dog needs surgery, stuff always comes up, and it never happens at a convenient time. If you don't have a cushion, what happens when life throws you a curveball? You're forced to pull money out of your investments, and that's the worst time to do it. Let's say the market's down and you need $2,000. If your investments have dropped 20%, you'd need to sell way more just to cover your emergency, locking in a loss. That's the opposite of smart investing. That's why your emergency fund matters. It's not for vacations, it's not for new gadgets or investing opportunities. It's strictly your break glass in case of emergency money. Think of it as a financial airbag. You hope you never need it, but when life hits you at 60 miles an hour, that cushion can save you from a serious crash. So how much should you save? Start with at least 3 months of essential expenses: rent or mortgage, utilities, groceries, insurance, transportation, whatever it takes to keep your life running. If your job is unstable or you're self-employed, lean more toward 5 or even 6 months just to be safe. And here's the best part: once that emergency fund is in place, you're free to invest without fear. You won't have to panic when something unexpected happens because you're already covered. You've built your base, now you can grow. Part 3. Opening your first investment account. Alright, you've got your emergency fund in place. You're ready to take the next step. So where does your money actually go when you invest? Simple. You need an investment account. Now, I know that might sound intimidating, but the good news, this has never been easier. You don't need a Wall Street broker or stacks of paperwork. Thanks to modern investing apps, you can open your account right from your phone, often in under 10 minutes. Here's the key: make sure it's a tax-advantaged account, because taxes can seriously eat into your profits over time. And if there's a legal way to avoid that, why wouldn't you use it? Depending on where you live, there are different options. If you're in the UK, look into a stocks and shares ISA. You can invest up to $20,000 per year, and here's the best part: you pay 0 capital gains tax on anything you earn. That means more of your money stays with you, not the government. Now, if you're in the US, your best friend might be a Roth IRA. You can contribute around $6,500 per year, and while you put in after-tax dollars, your investment grows tax-free. Forever. So when you retire, you don't owe a single cent in taxes on your gains. That's a massive win for future you. So how do you pick the right platform? It depends on what you're looking for. Mark Tilbury recommends Trading 212, which is a great app with 0 commission trades and an easy interface. Other solid options in the UK include Freetrade, Hargreaves Lansdown, or Vanguard UK. In the US, you've got Fidelity, Vanguard, Charles Schwab, SoFi, and Robinhood, just to name a few. Look for platforms with low fees, user-friendly apps, and solid support if you're new. Bonus tip: some platforms even give you a free stock or bonus cash just for signing up. It's not life-changing money, but hey, it's a nice little boost to get started. Once you're signed up, funded, and ready, that's when the real fun begins, because now it's time to choose your investments. Part 4. What should you invest in? Okay, your investment account is set up. You've got your emergency fund, and you've even deposited some money. Now comes the big question: what do you actually invest in? This is where most people freeze. They imagine Wall Street guys yelling into phones or trying to guess the next Amazon or Tesla. But good news, you don't have to do any of that, because here's the truth: picking individual stocks is extremely difficult, even for the pros. That's why for most beginners, the smartest move is to start with index funds. So, what's an index fund? Think of it like a music chart. The S&P 500 is like the Billboard Top 500, but instead of songs, it tracks the 500 largest companies. In the US, Companies like Apple, Google, Amazon, Microsoft, Tesla, all in one fund. When you buy an S&P 500 index fund, you're not betting on one company. You're buying a tiny piece of all 500. It's simple, it's diversified, and it has very low fees. Mark Tilbury recommends index funds for most beginners because they let your money grow with the market without you needing to watch it every day. Now, Dave Ramsey takes a slightly different approach. He still believes in long-term investing, but he prefers actively managed mutual funds, the kind with real fund managers trying to beat the market. But here's the catch. He doesn't just pick any fund. He looks for mutual funds with a 10+ year track record of outperforming the S&P 500, and he doesn't put all his eggs in one basket. Dave recommends splitting your investment across 4 categories of mutual funds: growth and income, large cap. These are the big, stable companies. Think steady, reliable growth. Great for peace of mind. Growth funds, mid-cap. These often mirror index funds. More potential, a bit more volatility. Aggressive growth, small cap. Riskier, smaller companies that can skyrocket or crash. High risk, high reward. International funds, these invest in companies outside your home country. Adds global diversity, but they've historically underperformed US stocks. By spreading your money evenly across all 4, you create a well-diversified portfolio that balances growth and risk. Bottom line, you don't need to be an expert. To start investing, you just need a plan. Start simple, stay consistent, and your future self will thank you. Part 5, the power of automation and consistency. All right. Let's be real, it doesn't matter how good your investment plan is if you don't actually follow through. So here's the most important step. Make your investing automatic. It ups so that money moves from your bank account into your investment account on a schedule, maybe every payday or once a month. It's easy to do. Most investing apps and platforms now let you set up automatic transfers and investments. Some even let you build a custom portfolio, or what they call a pie, and automate deposits into different funds without you lifting a finger. And here's the secret power of this. It builds consistency. Let me give you a real-world example. Mark Tilbury's son invests just $5 a day. That's the cost of a coffee or a sandwich. Doesn't sound like a lot, right? But over time, those small daily amounts add up to over $1,800 a year. And thanks to compound growth, that can turn into hundreds of thousands or even millions. Over a few decades. It's not about the amount, it's about the habit. Now let's talk about something most investors will experience at some point: a market crash. The market doesn't just go up in a straight line, it dips, it crashes. It gets scary, and when that happens, your instinct will say, sell everything before I lose more. But don't. This is where automation protects you, by keeping you investing on schedule, no matter how the market feels. Dave Ramsey says this is where having a good financial advisor can really help. Someone to keep you calm when everyone else is panicking. But even if you don't have an advisor, just remember, the market goes up and down. Always has, always will, but over time, it goes up. Want proof? Mark Tilbury started investing right before Black Monday, the huge 1987 crash. He's lived through every major market dip since, but instead of pulling out, he stayed the course. And today, he's a multimillionaire. Not because he got lucky, but because he stayed consistent. That's the real power of investing, not in chasing trends, but in showing up month after month, year after year. Part 6, Real Numbers. What could your investments become? Alright, let's get to the exciting part. We've talked about what to invest in and how to stay consistent. But what could all this actually turn into? Let's do some math. Real simple numbers. Say you invest just $250 a month. That's not a fortune. It's about the cost of a decent phone plan and a few nights out. Now, let's say you do that every single month for 31 years. By that time, you'll have invested roughly $94,000 of your own money. But here's where it gets interesting. With average stock market returns, around 10% annually, your investments could grow to over $1.1 million. Yes, from just $250 a month. Now, let's stretch that out. What if you keep going for 40 years instead of 31, still investing the same $250 a month, no more? Your total contribution becomes about $120,000, but your investment, it could be worth $3.5 million or more. That's the power of compound growth, your money earning interest, and then that interest earning more interest. This is why starting early is such a big deal. Even small amounts, when given enough time, can turn into life-changing wealth. Now, if you're watching this and thinking, $150 a month is all I can afford, good, that still works. You're building the habit, you're buying time, and time is your greatest ally in investing. The earlier you start, the more compound growth works in your favor. That's why financial mentors like Dave Ramsey and Mark Tilbury always say, it's not about getting rich quick, it's about getting rich eventually, and eventually starts today. Part 7, don't invest in what you don't understand. Let's wrap with one of the most important rules in the entire world of investing. Never invest in something you don't understand. That might sound simple, but it's where so many people go wrong. Here's what happens. A friend says, you've got to buy this stock, it's going to explode. Or you see a video online hyping some obscure crypto project or penny stock, and suddenly it feels like everyone's making money, except you. So you jump in, but you don't really know what the company does. You don't understand the risk. You just hope it goes up. That's not investing, that's gambling. And here's the sad truth. Most people who chase hot tips get burned. The hype dies down, the stock crashes, and they're left wondering what happened. That's why mentors like Mark Tilbury and Dave Ramsey are so adamant about this. Don't put your money into anything you can't explain to a 10-year-old. You don't need a degree in finance, but you do need a foundation, a basic understanding of where your money is going. If you do want to buy individual stocks, great, but do your homework. That means fundamental analysis. What does the company actually sell? Who runs it? Are they profitable? Is their debt manageable? Are they growing or just surviving? If you can't answer those questions confidently, it's not time to invest yet, but here's the good news. If you're just getting started, you don't even need to pick individual stocks. Just stick with index funds or high-quality mutual funds with long track records. And when you do take advice, make sure it comes from someone with the heart of a teacher, not the mouth of a salesman. Someone who explains, educates, and empowers you, not someone just trying to get your money, because in the end, the best investment you can make is in your own understanding. Wrap up all right, let's bring it all together. You've just learned the core building blocks of successful investing. So let's do a quick recap to make sure it all sticks. First, build your emergency fund. Before investing a single pound or dollar, make sure you've got 3 to 5 months of living expenses tucked away. That's your safety net. Second, open a tax-advantaged investment account. In the US, that's something like a Roth IRA. In the UK, it's a stocks and shares ISA. These accounts let your money grow without the tax bite. Third, choose a smart, simple investment strategy. Don't overcomplicate it. For most beginners, index funds or time-tested mutual funds are the best path. They're diversified, they're low cost, and they work. Fourth, automate your contributions. Set it and forget it. Whether it's $5 a day or $200 a month, make it automatic. This is what builds consistency over time. Fifth, stay invested for the long term. The market will go up, it will go down, but the people who win are the ones who stay the course. Don't try to time it, just keep showing up. And finally, understand what you're doing. You don't need a finance degree, but you do need to know the basics. Don't follow hype. Follow education, host. Leans in slightly with warmth. Listen, you don't need to gamble. You don't need to be perfect. You just need to be consistent. Because the truth is, the key to wealth isn't genius, it's action. Even small amounts invested steadily can turn into millions over time. That's not magic, that's math. And it works. If you work it, if this video helped you out, go ahead and hit that thumbs up. It really helps this channel reach more people who need this info. And if you're serious about building wealth for the long term, hit subscribe and ring that bell so you don't miss the next one. Let me